So good morning and welcome to this e-Memoir session. We're looking at understanding changes to the funding of apprenticeships and how to make the most of the levy. We're joined by Beej, and we like to keep these sessions as interactive as possible, so please feel free to use a question or chat facility to put your questions to us and we'll be happy to help. I'm going to mute my microphone now and I'll hand over to Beej. Thank you very much.
That's great. Thanks very much, Marek, and good morning to everyone, particularly to our regular subscribers and regular users. Good to see you back. To those of you new, I hope you enjoy this morning's webinar. Over the next 50 to 55 minutes, as Marek says, I'll be looking at two things. Just, I suppose, reflecting and getting a better understanding of the changes to apprenticeship funding since the beginning of May, particularly taking account of the new documents that came out at end of April, updating the apprenticeship funding and performance management rules to take account of the interim arrangements clearly that are in place now for non-levy paying apprenticeship funding. That's with the smaller, obviously, employers. I'll be focusing a little bit on the impacts of the procurement process that many of us, and I know those of you listening in, endeavoured to grow some of our provision, or at least in some cases to move away from being a subcontractor to a main contractor. I want to reflect a little bit on the implications of that. And also in the latter part of the webinar, as Marek says, focus on how to get the best out of the levy. And what we found certainly, and I'm talking here as a non-executive director of a large training provider, as well as a governor of an FE college which provides apprenticeships, how we're making the best out of the levy in terms of engaging with levy-paying employers and the sort of processes that we've been going through. I think that you might feel that you've got some commonality, some common ground with that you maybe have learned the same things as us, or there might be some new things that we learn as a result of today. Happy to take questions as we go along. If we can't answer all the questions, we'll certainly try to do so at the end once we stop the recording, or if not, certainly we'll do a bit of research and then get back to all of you. Okay, so what I wanted to do was partly reflect something that came to my mind last week when I was talking to upwards of 50 employers and providers at a meeting in Wolverhampton. And we've been doing quite a lot of briefings for providers and employers over the last year. But this was obviously last week. It was, and some of the people in the audience were levy paying and some were non-levy paying. Some had already started with new apprentices on frameworks and standards after the 1st of May. However, there was still quite a significant amount of confusion, even from those that thought they knew a fair bit about the way that funding was going to work from the beginning of May. That confusion arose from those that still understood what a framework was, understood what SACE was about, coming to terms with the standards, the move towards standards, how standards were different from frameworks, reflecting on the differences in content, in approach, in delivery, and in particular on endpoint assessment. And where obviously that was creating some concern was where there was a standard but no endpoint assessment organisation appointed yet, or no clear form and understanding what it was going to be about. I think quite a lot of the employers were interested in what were the developments in terms of the levels of apprenticeship, very familiar with intermediate and advanced, but higher and degree apprenticeships was something that they found quite interesting, and obviously something that might reflect the changing nature of apprenticeships as a product in obviously those changing markets. What was of interest to all of the employers was that although it's a UK tax, the levy is, don't forget, it's a payroll tax that applies to all businesses of a certain size across the UK, was the arrangements for allocating and then using the levy differed between England, Scotland, Wales and Northern Ireland. And that obviously still raises some issues for those of you who are listening in, who are providers that work across those countries, as well as employers that employ people. Key thing here was obviously we're going to focus very much on the English solution, and that's going to be the focus of today. But to be aware that in Scotland, for example, where there's over £200 million worth of levy, that levy, although a lot of it will be spent on apprenticeships, can also be spent on other forms of training and development for employers, and also deliver some of the devolved governments ambitions in terms of getting people into job and getting people into higher levels of training. The Welsh system will certainly not be using a digital account. They have a different model. Also, the Welsh Assembly government has got some significant priorities that it wants to address through the allocation of its apprenticeship funding, whereas in Northern Ireland, of course, everything has been delayed until September because of the issues with the devolution of that and the fact that the administration is no longer operating in Northern Ireland. So we're going to focus very much on the English system. Also, some concerns from, well, am I a levy paying or not? Some employers were confused because they didn't realize that they were part of a bigger group, and therefore, although their individual pay bills were less than 3 million, the group's pay bill was more than 3 million, and obviously how that was going to be shared out across the group was an intriguing issue. Also, some employers were moving between the levy and not being a levy payer by the month because of the seasonal nature of work, etc. So these were some issues that obviously were raised. For those of the providers and the employers that were from England, they of course were commenting on the fact that 3 systems could be running at the same time, and I'll come back to that in a minute. All of the employers and the providers had some concerns about how the 20% off the job training would work. How would it fit into busy work schedules? Is it just a day release and block release model? How can we demonstrate e-learning and blended learning? And obviously issues about what was the value of the 20% off the job training, which of course doesn't include the time that's needed for things like English and maths. So I'll focus a wee bit on that. Key issue for many of the employers was what can the levy be spent on, particularly in terms of training and assessment, and obviously that raised the issue about apprenticeship wages, which of course clearly it can't, although that was part of one of the agendas on the election. I think for a lot of the providers, some of whom are subcontractors who at the moment are working with a main provider, a main contractor, was about how the procurement process would work after it was resumed. Hopefully we would know that before the end of this year, but certainly all those arrangements apply until the end of December this year. So what I want to do is look at some of those areas of confusion. I think the key thing is that it's well clear in everyone's mind that in England, the reform programme was very much about moving from a provider-controlled system, whether you're a college, a training provider, whatever, where essentially we were the key actors along with the employers, but we would be where the funding came to, and obviously we were responsible for delivering with the employer the SACE framework with all the component parts. For young people, that was fully funded. That was quite a good rate, for example, which would assume 100% the cost would be covered by the government. And where there was an employer contribution of 50%, in some cases more for a larger employer, there was an expectation that that would be collected, but it wasn't always collected. It wasn't always in cash. It was often in kind. What confused, certainly employers understanding the system, was there were different rates for ages. 16 to 18, 19 to 23, 24 plus. The other factors would come into the calculation of cost, although they often didn't involve the employer, such as the location of the training and things like the postal code of the apprentice. So we were determined to move to a system in England where the employers would have more control over 2 aspects. They would have more control over the curriculum, what was actually the content of an apprenticeship, and particularly this was what was going to be tackled or addressed through the trailblazers designing these new standards, these new apprenticeship standards. And secondly, to give the employers much control over the funding. So instead of the funding coming primarily to you, it would be through the employers, through a system of contribution for the standards, which was piloted. For every £1 that the employer put in, there would be £2 from the state, but it did require a cash contribution from the employer, which would give them more control and obviously more interest and more, if you want, ownership of an apprenticeship, but also through incentive payments, such as for young people, for completion, and for smaller providers that would be going to you, but then being transferred to the employer. So this would remove some of the complications such as area cost uplifts, disadvantage uplift, which of course employers didn't really have to focus a lot on, but certainly were the focus of us as providers in making sure that the cost of supporting an individual apprentice was fully reflected. What was of course quite interesting in the transition, particularly through the Trailblazer standards, was of course the emphasis that was being put on new models of assessment, more emphasis on teaching and learning, a different role for the assessor, certainly much more of a tutoring role, and of course the impact of endpoint assessment and how apprentices would have to complete most of their program, get through the gateway, be ready for endpoint assessment, and all of the conditions that would be applied there, and all the issues that this raised about the suitability of endpoint assessment in different shapes and forms, and also the inclusion of qualifications or not within the new standards. So in terms of transition, which we've been going through for the last 2 or 3 years, there's quite a lot of issues still to be resolved as we move from frameworks to standards. But with that in mind, after the 1st of May, it was very much saying that as we move towards increasingly replacing frameworks by standards, and this will take obviously time, is to give the employers much more control over the funding of apprenticeships. And this would start with large employers with pay bills of over £3 million paying an additional payroll tax of 0.5% of their pay bill through the taxation system into a digital account known as the apprenticeship service account, and that would then be used to pay for training and assessment. And of course the government would then do a 10% top up to that fund, and that would be used and would only be used in England. This is not like Scotland, for obviously the support for frameworks and standards. For the majority of employers who were not going to be levy payers, what was exciting us as providers was that they would be co-invested at 90% from the government, 10% that we would be collecting from them in cash for the cost of training and assessment, plus obviously incentives to do with employing young people and other aspects of cost which would be in transition supported. But that wouldn't involve the employers, it wouldn't be part of a digital account, it wouldn't be part of the price that you agreed with a small employer. Those would be earnings that would come to us as providers with evidence obviously provided through our data, through the individualized learner records, etc. What was critical here, and this was significant, and this was the attraction to those of us who are subcontractors, was that there would be a new register of apprenticeship training providers with clear indications of what would be the sort of standards required to be directly funded, and that would apply from the beginning of May, and all of us would have to go through it. So Maine and those subcontractors who wish to get a contract in their own right, we apply to go through the register of training providers and get on it, and many of us are on it. There's been a second group that have got on. But also at the same time, there was an ITT, a procurement exercise for the first, if you want, £440 million worth of non-levy paying allocations, which would have applied after the 1st of May. And obviously that's something that I want to focus on. So with that in mind, and that direction of travel, key thing to remember here is, and this is the first point I want to make, is that as a provider, and we're operating here obviously as a main provider in both senses here, is that whether you're a large or small, working with large employers or small employers, the key thing is that all of these new arrangements applied for new starts after the 1st of May this year. So the key thing here to remember is that in terms of your existing contracts with on frameworks and standards, they would continue to the conclusion, either to the completion of the framework or standard, and in the case of standards to the completion of the endpoint assessment. So in other words, what you've already got, and these were confirmed several months ago, would be an allocation based on your existing learners before the 1st of May, and they would be covered by, right up to the end of their framework or standard, by the terms and conditions that applied before the 1st of May. So that would be the old system for frameworks, you know, based on the 2010 calculator, you know, where every aspect of the SACE was separately funded, and of course on the apprenticeship standards with the system that I showed in transition, the £2 for £1 plus incentive payments. So it is critical that you realise that what's sustaining us, and certainly that was the first thing we looked at, was the size of that. And that allocation obviously is not affected by any of the changes that we'll talk about that obviously were announced in the last few months. So our carry-ins are a significant part of our provision and a significant part of obviously our funding from now until those completion. So in other words, I think what is critical is that if we now talk about what's happening after the 1st of May, if you're working with a levy-paying employer, or if you've been given an allocation, it might be reduced, I know, to work with non-levy paying employers, or if you're still a subcontractor, these only apply to new starts after the 1st of May. So there's no way that employers that, for example, are levy paying can use what's in the levy to pay for apprentices that started before the 1st of May. So as I want to just re-emphasize, carry-in learners are not part of this allocation for non-levy paying employers. That's the interim allocations that we've been given to the end of December 2017. And also, obviously, that's not being affected by what you're securing through levy paying employers who you're obviously contracting with. So I think it's just important to realise that obviously a large chunk of what we've got as our allocation is made up of those carry-ins, and that should be something that assures you and gives you security. The extensions of that with the non-levy paying, I'll pick up in a few moments. So to just remind you, because this is a bit of an update, the basic nature of our apprenticeship funding policy post-May in England is in these blocks, and it starts with the funding bands. All new starts, whether it be frameworks or standards, in those 15 bands. And obviously that's affected some of these allocations that you were given for new starts after the 1st of May, because those new starts might be on a framework which might bring in less money than you're currently getting, or it could be on a standard where you're getting more money than you were getting for obviously a framework. And that's going to be taken account in why sometimes those allocations that you've been given for new starts are different from what you might have expected. But of course the key issue here is that those funding bands are ones which to some extent set the top level for anything that you're agreeing with employers, whether it be large or small, in terms of the price that you're getting paid for training and assessment. Remember, the bands do not cover any of the incentive payments. They do not cover English and maths, etc. They're purely the cost of training and assessment, which of course for standard includes endpoint assessment. What was critical was for us to understand that the big incentive for us to work with non-levy paying employers was that any new starts after the 1st of May, the co-investment rate for those employers would only be 10% of the training cost. However, that was still 10% in cash terms that would have to be transferred to you, and the government would make up the remaining 90%. That co-investment also extends to levy payers who have not got enough money in their digital accounts to pay for any training and assessment, who then would move on to co-investment, and I'll show you that with an example later on. When we then looked at the incentive payments, there was incentive payments of £1,000 to the employer and £1,000 to the training provider for every 16 to 18-year-old that's taken on an apprenticeship framework or standard. And of course you have to then transfer the £1,000, because both thousands come to you, one after 90 days and one after 365 days, so it's in two halves. Those obviously would be transferred to you. In the interim, for a transitional period, and the key thing here is the apprenticeship funding and performance management rules that were updated in April essentially still have these main components. There are some little changes that I will refer to. But for the transition, for any frameworks, this is frameworks only, if you're taking on a 16 to 18-year-old or a 19 to 24-year-old who's in care or with an education healthcare plan, we then uplift the value of the framework by 20% on top of any price that you negotiate. That 20%, by the way, is based on the top of the band. And that obviously, again, comes to you against performance in terms of each month that you will get. If you've got a framework uplift, you'll see that coming to you, being earned each month through the funding formula. And obviously that's recorded on the ILR. For those of you working particularly with small employers with less than 50 employees, you do understand that from the 1st of May, any 16 to 18-year-olds they take on, or 19 to 24-year-olds in those protected categories, they will not be expected to pay a 10% contribution. So the employer gets 100% of that covered. That's 100% of the training and assessment cost. So when you negotiate the price, clearly an incentive there is to go for the top price in the band. I understand that. But also the incentive payments around that I talked about above. Obviously against the learners still being in learning. The other thing to note is obviously that additional learning support, and by the way, these incentive payments, if you look at your allocation, that's your interim allocation for new starts, for small and for non-levy paying employers after the 1st of May, these are included in the allocations, and that's one thing I think that needed clarifying. This also means that, for example, any apprentice, whether it be a framework or a standard, who has additional learning support that you've assessed and then identified and then supported is again fundable at £150 a month. We also, for the interim, have continued to fund those learners that come from disadvantaged postal codes. These again come through the ILR, they come to you based on that distribution of which apprentices come from the most deprived areas. And as we all know, English and maths is also separately funded. Again, for those that need it, if they haven't got the level of functional skills or GCSE needed, that's funded at £471 per level, per subject. And again, these are not payments that are part of your negotiation with employers. They're again coming to you as part of your allocation. And in this case also to remind you that for the English and maths, there is no, if you want, completion element. Whereas obviously for the main framework or the standard, there is a completion element, which is 20%, 80% is what we call the instalment. For English and maths, it's 100% on program if you want, and there's no completion element. The other thing to note is that clearly one way of taking advantage of the levy, increasingly I think, but not exclusively, is to obviously work with the employer who might not be taking on new apprentices, and that clearly is not always the case, but who, through some kind of needs analysis, through some kind of work that you would do, and certainly as a provider, we've been doing that for nothing for our employers, is to then identify where there might be new skills needed, new roles demanded, where we would be able to take existing staff through an apprenticeship, either in a different area altogether or at a higher level. And the key thing there to note, by the way, is the condition is it must be because they acquire substantive new skills. So I think just be wary of that, and how that's defined is well worth looking at that. So in terms of the apprenticeship funding policy, what does this mean when we start looking at making the most of the levy? Well, in terms of the levy payers, and I know that that many of you have identified levy payers. I was with a provider yesterday that's working with over 40 levy paying employers, which I thought was really sort of testament to the fact they've put a lot of energy into activating that market. The only difference is really there for levy payers, other than the way that the money goes into their digital funds and then they're being topped up by 10%, is, and that's clearly the case in England, is obviously to remind levy paying employers that if they don't use the digital, the money in their digital accounts, they will lose it after 24 months, and that's done on a first in, first basis. So if month 21 is not used, then by month 25 it's lost. And that goes back into the overall pot, is also to make sure you keep on reminding them that that only applies to new starts. I found this a bit of an issue. It doesn't apply to any of the staff that were employed and on an apprenticeship before the 1st of May. It only applies in England to those, that proportion of their staff whose main place of work is England. That means they spend at least 50% of their work time in England then they're covered obviously by that. And that's why you'll find that with some levy paying employers, the levy might be 3 million, but how much is available in England is only 2.9 million, because 100,000 of that is being covered by, say, an arrangement in Scotland or an arrangement in Wales. One thing that we have been pushing for through AELP and other organisations is, particularly when we're working with levy paying employers, the frustration we have is, I've got your large employer with a big supply chain. The large employer is not going to use up all of their levy. They're not going to use it all up. They would like to transfer some of the levy to their supply chain, which would improve the quality of product and service they're getting. They're not allowed to this year. Now, from 2018, the indications are that the SFA will allow levy-paying employers to transfer a proportion. The figure was originally 10%. I would be happier if it was higher. 20% would be a good start, of their funds to other employers within the digital system and to things like the apprenticeship training agencies. So I think that's something that we still have to watch out for, but nothing I think will happen until 2018, although we're obviously pushing for it. So with that in mind, you've got the new arrangements across the whole of the levy, non-levy paying, if you want, landscape. We've got the specifics that relate to the levy paying. I think the big issue, first of all, in understanding the funding is how these new bands work. And obviously all existing and new frameworks are placed in these bands as part of simplification. The upper limit in each band either sets the maximum amount that can be transferred from a levy-paying digital account, or would be the basis for 90% contribution from the state and 10% contribution in terms of co-investment. Key issue, I suppose, is what's this meant in terms of negotiating the cost of assessment, particularly when you've got to include an endpoint assessment, when you're explaining to the employer that, for example, in band 11, £15,000 includes the cost of all the assessment, the off-the-job training, all aspects of the training, and getting the person through the standard of the framework. And with a standard, of course, it has to include the cost of the endpoint assessment. And that could, of course, retaking elements of the endpoint assessment. So just as a question, and we're getting some cracking questions, which I know I'll be able to answer later on because they relate to some of the stuff I'm looking at. Just in terms of those issues about the funding bands, what have you as providers particularly found so far in terms of negotiating prospective apprenticeship starts after the 1st of May? You've been doing this for the last few months with levy paying and with non-levy paying employers. What have you found in terms of the practicalities of discussing these prices and these bands and explaining the bands? I think one of you has already said, how do you approach it? It's a good question. We approach it as a provider in both cases by always saying that, for example, band 11, where we've got some of our apprentices, is that we start at £15,000, and we say that that's what we would think is the right price to cover all elements of the training, the off-the-job training, the materials that we might have to provide, the access to an online digital assistant as well as the cost of the endpoint assessment. This is in advanced manufacturing, which would be somewhere around £1,800 to £2,000. So we start at £15,000, and that's what we've actually been able to negotiate with our employers. Now, I know that some of you have said that the employer wants more. They want, for example, a qualification in a standard where the standard does not have a qualification. If that's additional, then that's got to be something that's out with these bands. So, for example, you might negotiate £16,000 where the band stops at £15,000. That extra £1,000 that the employer has agreed to pay you, that's got to be separate and cannot be recorded because these are the maximum values in the bands. So that's something to be aware of. So good point there. And I think that's what some of you are saying. It's still still waiting to do the negotiations. Others, of course, you've already got into those and you found them quite interesting in terms of what's expected in terms of pricing and what the value for that price is going to be. But again, cause some confusion because some of the employers will say, well, what happens if there isn't a qualification inside it? Can that be part of the sales pitch that you might make? And obviously clearly it is. For co-investment with the non-levy paying, I think we've got to understand that that's where the bulk of our work is. Certainly the majority of our employer partners are small, and they will obviously be only having to make a 10% contribution. How we get that in cash, obviously we're expecting it in advance wherever possible against an invoice. We've tended to go for a 3 months in advance model, and that comes to us as cash. Then we can record in the ILR that over the first 3 months, by the time we get to month 3, we've received the right amount. I know some of you are trying to get the payments up front. I think anything in arrears is a bit more problematic. Remember, this also applies to those large employers who are levy paying, who might have exceeded their, the money in the digital account. Remember, the 10% does not apply if the employer is eligible for extra support for small employers. In other words, if they got less than 50 staff. So again, just to focus on that. So we understand how the system works for those employers that pay the levy, and I know some of you are listening in are obviously levy payers. So we know that we've made the first transfers in April. That's when we had to pay the first tax. Money's coming into our digital accounts from May. That's then being topped up by 10% from the government, and I know that some of us in June expect to make the first payments to providers, and that obviously will come through the ESFA because they're responsible for making that process work. So for example, if this is one of our partners, they have a pay bill of 5.4 million. You can see the levy will be 5% of that. That's 27,000. We all get annually a tax-free allowance of 15 grand. That's 12 grand therefore that this levy payer will have to pay. The government tops it up by 10%. You can then see over the next 12 months how that top up and levy payment will work. How much you then have available to how much you spend depends on each of those months, how many apprentices are on standards or frameworks. And these transfers would be the transfers of 80%, because these would be new starts. So these would be the 80% transfers that cover the cost of our ongoing assessment, depending on how long you've actually set the apprenticeship for. Again, remember the rules still apply in terms of minimum 12 months, etc. And that just simply shows us our balance on account. Remember, these are the what we call the installment payments, the 1,200 to 1,200. You can see they vary by, depending on the level of activity that you've got. The completion payments obviously will come after 12 months or whatever is the length of time for that particular. So for that particular apprenticeship. The way the digital account works, I think we're all fairly clear. The money goes in and then it goes out on the first in, first out. So that's why we have to prioritize the learners. So we either prioritize them by the start date. However, if you've got apprentices that both start on the same day, 2 apprentices start the same day, we just do it through the unique learner number. And I think you've all seen different calculators that show you how to work. And don't forget, the money that's coming out of the digital account each month reflects the 80% installment payments. Later on, it will also reflect the 20% completion payments. So here's an example of how it works with a levy-paying employer that has enough money in their digital account. Again, it's just an example where the maximum price is 15,000. We've negotiated 16,000 with them. They make us a £1,000 payment against a separate invoice. In this case, it might have been for a qualification, or it might have been for some kind of added service. And then we collect the 15,000, split 80% over the monthly installments. Let's say it's a 24-month framework or standard. And then obviously we get the £500 coming to us through the digital account. The completion element after month 24 would be 20%, and again that would come to us from the digital account as long as there's enough money in the digital account. Here's an example of what would happen if there wasn't enough each month in a digital account. So you can see a proportion comes through the digital account, and then a proportion comes from co-investment. So we would record that employer on the ILR as both a levy payer and co-investor for those different and respective amounts. And you can see how that would work, therefore. For example, in terms of the completion element, 20%, a proportion would come from the digital account and a proportion would come from co-investment. Here, the employer would only have to find 10%. I think that's one of the things that we have to understand is how that would work. I know we are the providers here, but we have to understand how it's going to work with our partners, because after all, it's them that's in control of the money. It's them that are actually, that have that power. In terms of employers that don't pay the levy, and obviously this is the most significant, we start to look at we have a different arrangement. They will not be in digital accounts initially. They'll be asked to make a 10% contribution, and obviously they will be choosing you to work with either on the basis of the direct contact with them, and obviously you have to be on the register of apprenticeship training providers to do that. I mentioned the cash transfers, and here's an example of how it might work. Exactly the same scenario, but again, how it might work there. So you can see that there, 80% is spread again over the 24 months. The government makes the 90% contribution. That obviously comes to you through the ILR as the provider, and the employer makes a contribution of 10%, which again comes to you against invoice. As we said, all of those arrangements are fairly clear. So with the funding in place and us now having, I think, a better understanding, there were one or two sort of what I would say continuing concerns. The first one was, have we simplified it too much so that we've got rid of some of the things that actually reflected real costs, such as disadvantage costs, the cost of supporting younger people? We said that employers, if they want more control over both content delivery and, content, which includes curriculum, then obviously there would have to be some issues about how they would understand the pricing scheme system as well. So what we had at this point was to say that, yeah, that's good, but what happens with a situation where those simple rules, when you actually get into the detail, become a little bit more difficult. For example, the 20% uplifts, the additional payments, they're all driven. The 20% uplifts are done by months against installments. The additional payments are done after 90 days and 365 days. By the way, that's for 16 to 18-year-olds, not 16. Many of these things only apply in the short run. So I think we've still got some sort of questions, particularly if some of those changes only apply for 1 year or are transitional. And how's this all about quality? Because we've not mentioned that yet. How do we maintain and improve quality at the same time as we change content and change methods of earning? And of course the big issue for us is, when's all the procurement for non-levy paying employers to resume, because whatever being given as an allocation is not the one that we were maybe in most cases expecting. So before we go any further, a couple of questions coming your way. We've got one question coming here: by what method do employers pay the 10% if they run out of levy money? This is, again, you would then immediately move into saying to them that you'd have to invoice them for that, and then they would have to pay you exactly the same way as a non-levy paying employers. But of course, and that's the way I've understood it. I have not seen any difference. I can't understand how it would work for the digital account because there is no money in the account. So I think the key, and this has come from Rebecca, the way I understood it, and I've read this question's been posed, it was posed last week by one of the providers. We've always understood that because there is no money in the digital account, you cannot run the digital account at a negative amount. So we've assumed that what you immediately do is you record that on the ILR as being co-investment, and then the ILR would then be looking for where's that 10% contribution from the employer for anything above what's in the digital account. So I think that's one of the things that I would agree that one of the experts certainly has got wrong. Thanks for that. That's a good question, Rebecca, before we moved any further. And that's the understanding that we all, of the majority of us, have certainly had, certainly point of view, when I've asked my MI team, they've actually come up with the same response as you have correctly identified there. So what was happening in terms of, okay, we've gone on to the ROATP. After the 1st of May, we've been negotiating, and we've already negotiated very successfully with levy paying. We've done very well with levy paying employers, and that's been actually quite important. When we've added that on to our carry-ins, we're actually doing quite well. That's carry-ins on previous contracts. What happened with the £440 million of procurement, which many of you went for, under the ITT that was published last year, is the actual bids have been alleged to be around 1.6 billion, although I've never seen actually any confirmation of that. But anyway, let's use that figure. The procurement process was then paused because of the excess bids, and obviously a lot of us, either as main contractors or as subcontractors who went onto the register who wanted to become a main contractor was bound to happen. The process was paused, partly because I think there have been other issues about have we got enough funds to fund all of the activity? Is the 3 million still the sort of target we've got? What's happening in terms of uncertainty in terms of the economy? And we got the if you want, from the ESFA, these assurances that there would be contracts, existing contracts would be extended until the end of December. So don't panic. You will be able to get some new starts funded with smaller employers after the 1st of May. But also it would be important that that those people who had existing contracts would have them extended. You'd have to be on the new register, so obviously that was clearly a driver for those main contractors that hadn't got on the register for whatever reasons, and there were some of those. But I think obviously what it did say to us and to our partners who are subcontractors was, so you can't now become a main contractor, although we do want you to be on the register. That's what we call the rule. However, you'll have to continue to work as a subcontractor with your main. And of course, that's been the concern that AELP and various other organizations have said has created panic, concern, confusion, and in some cases, leaving the sector already. Because obviously, if I'm a main contractor, and I've had my allocation after the 1st of May for non-levy paying employers reduced for whatever reason, we'll look at that in a minute, then clearly I might try and maintain my own provision, my own direct provision. I might have at that point terminated my relationship with a subcontractor. And that was obviously one of the key concerns. So we've got a pause. We then get our allocations in late April, and you've been looking at them, and I'm sure many of you have. And what I think was very clear is that we wouldn't necessarily get the full value of what we were seeking or of what we'd had in the past. And and those are two quite separate things, because clearly if I had run my existing provision through for another 8 months, I would have expected a certain amount. So in other words, I would have just modeled it and gone forward. However, you can't do that because, for example, those of us who were bidding for significant growth, that's not going to be funded, because that's why the thing was paused, is to look at your existing provision, what you've already done, your carry-ins and what you did in terms of the last year, and then say, well, let's roll that forward. However, you'd have to then take out a little bit, because some of those providers, some of those employees you worked with in the past are levy paying, and that's a separate contract, a separate system, because you contract directly with the levy paying employer and get paid through the digital account, so you have to subtract them. Similarly, we're not comparing like with like. We were traditionally doing lots of frameworks. We're now moving over to standards. They can, in many cases, have a different value, and of course also have even the frameworks have changed the value, and the standards often have a different value, often higher, particularly for the same subjects. So you're not comparing like with like, so that's why your allocation might have been reduced. And of course what's assumed is that we're also saying that we have to take a little element out, because you're going to get the 10% in cash from your non-levy paying employers. So given that, and there are other things that would have come into it, and I'll come back to that, there are many providers that are saying, well, yeah, I've done that, I've modeled it, I've had a chat with my ESFA contracts manager, it's still not the same, it's a lot less. Now, we obviously took a hit, on both occasions we took a hit, but by the time we've factored back in, it wasn't as big as we thought. One of the questions, by the way, that one of you keeps, and it keeps on coming back in, it's Joss, I think, is where does VAT come into the amount you pay? Well, remember, if you're billing an employer for the work that you're doing within one of the 15 bands, that price cannot include VAT. So obviously that is an issue, because, and we have now got our situation where we're asking, because we're remember, as a training provider, we do charge VAT. As a college provider, we don't. Is to get some ruling from a VAT tax expert on how that's going to work. But in most cases, we're obviously saying that we're going to have to make sure that that price that we quote it doesn't then have VAT added onto it. Because if you said it's 15,000, then I'm going to add another 20% on, that turns it to 18,000. Well, you can't exceed what's in the funding band. Remember, the funding bands do have to include implicitly anything that you're hoping to get in terms of the full cost of that provision. So what are the implications for providers? Well, I think there's two implications. And by the way, questions just come in. In terms of that allocation, we can understand how it's been reduced to take account of the proportion of levy paying starts. We can also understand why it's taking account of the differences between standards and frameworks and the new funding band. So it's two issues. What else would have accounted for it to be a different amount to what we expected? Well, obviously, first of all, can I just remind you, it's an 8-month allocation and it's covering only new non-levy apprenticeship starts. So it doesn't include levy paying, it's a separate issue. I know it's in 2 bits, there's a 16 to 18 and a 19, but that's just fairly standard process. It's maintaining, I think the key thing I've picked out here is your allocation does include funding for both frameworks and standards, and by the way, it does include any additional incentive payments, so it includes the 16 to 18, including the one you've got to pass on to the employer. It also includes the delivery of English and Maths. If you thought that went through, that's in that allocation. This is the non-levy paying. And it also includes learning support where it's required. Now, one thing I immediately realized is that in the current models, we had got, with frameworks, basically double payments in the first months for new starts. Well, in the new model, any new starts after the 1st of May don't have that N+1 double payment. So that's why it's slightly different. And also, don't forget, the new incentive payments don't apply until the person's been with you for at least 90 days. So those incentive payments for 16 to 18-year-olds might not apply because the 90 days doesn't happen within that 8 months. Does that make sense? Yes, so if you're taking on apprentices, you know, month by month on a continuous basis, by the time they get to December, there will be some that still haven't got 90 days in, which means, of course, that you will not, that will not include then the incentive payments. I think there's another good reason is that, and I think this is a fairly obvious one, is that when we asked which of the employers were levy paying and non-levy paying, there was a bit of confusion. There was some inaccuracies. Some of our levy paying employers were being counted as non-levy, some non-levy were being counted as levy paying, and therefore that had to be adjusted. What I think the best thing is to ask your ESFA contracts manager what the baseline was that they based this on. And there's a lot of advice. Those of you who are MI managers, if you go onto FE Connect, put in this issue about non-levy paying, and you'll see there's been quite a lot of dialogue between different providers, MI staff, about why those differences. By the way, we've also had quite significant reports of providers who've said that, in fact, those interim allocations have not gone down. So that's interesting. So we've got obviously a whole set of factors. I think what I've extracted from the implications for providers is for main contractors, yeah, the new allocations may have been less than were bid for and less than planned for. That's obvious because there was simply not enough resource in the first place. But obviously if it's less than you had got profiled against your past record of non-levy, that's where the issue arises. I think for some of us, it has involved significant investment. We were planning for growth, therefore started to put in place not only all the necessary support systems in terms of workplace tutors, etc., and now we actually haven't got that amount of work. One of the issues obviously that I just want to raise with you is that your allocations are still subject to performance management as an 8-month block. So therefore there will be opportunities to get growth funding during the period. So don't totally put aside any growth plans you've got, because performance management will still apply, and therefore as long as you've got quality, as long as you've got capacity. I think the big issue for us was that this would have given us a real move towards implementing standards, higher level apprenticeships, degree level apprenticeships, because essentially those interim allocations, those temporary allocations we've got for the next 8 months, are based on what we did historically, rather than what we were not based on our plans. and therefore our plans might have involved, for example, engaging with a whole lot of new non-levy paying employers, doing some higher and degree apprenticeships. That's, I think, going to be more difficult. However, the performance management and further rounds of procurement are still there on the horizon. Obviously, we're waiting to see when they happen. So I think we've still got to have those sort of commitments. What it has done for us as a main contractor, as a main provider, is it's really made us focus on working with levy-paying employers. And I think that's also applied to, obviously, some of our subcontractors that are on the ROATP, and have switched clearly from moving over from non-levy to levy paying. But of course that's not good when we're trying to activate those 98% of employers that are non-levy. I think the potential loss of provision could impact on the achievement of the apprenticeship target of 3 million new starts, but I don't know how relevant that really is. I've got a feeling that that's not the big issue. It's more about the quality rather than the quantity. Now, those of you who are subcontractors, and I know a few of you have posed me the question, how have Beej been affected? Well, you are under the existing rules, except for the addendum. I'll come to the addendum in a minute. You can continue to deliver new starts on the same conditions, except you've got to be on the ROATP to deliver in excess of £100,000 worth of apprenticeships, especially if that's across several mains. So I think that's got to be the key thing. The addendum, which the addendum to the apprenticeship funding and performance management rules, May 2017 to March 2018, has created some concerns. And let me just read the changes. In other words, this is exactly the same as was in the original rules, is that the only changes that you should note as the rule requiring the main provider to directly deliver a volume of training and or on-program assessment of some substance does not apply to delivery for non-levy paying employers. So in other words, you can have in some situations where the employer, where the subcontractor delivers the full apprenticeship in terms of assessment and substance. But can you note, Rule 13, SC 13 says that means that the main provider must obviously put that into their statement of distribution of income and how the fees are being shared. So that's quite important. Permission must be sought from us to subcontract for the first time. Well, I think that's obvious. Second level subcontracting is allowed on an exceptional basis, but permission must be sought from us to do this. So can you have a good look at, those of you subcontractors, have a good look at the addendum, right? Which also includes a little bit of advice on if you're working with, if you're a subcontractor who's responsible for the collection, recording and evidence of non-levy paying employer co-investment. That still stays with the main provider, but they can choose to give you, the subcontractor, money to collect and evidence it if required. When the subcontractor collects the co-investment, the financial transaction must be visible in the subcontractor's financial system. So there's a lot of visibility and transferability. I mean, many of the subcontractors had hoped to secure direct contracts, we know that, and therefore there's a disappointment. If on the RATP, and we know that from some of our partners, they've simply focused the direction more on levy-paying employers, 2% of employers, but they're substantial. And that in effect has meant there's a lot more competition. So the mains and the subcontractors are in a more competitive world trying to attract the levy paying. I think the thing I'm concerned about is that if subcontractors put a lot of energy and time into getting onto the register so they would in effect become a main contractor or a prime, that might have involved them in significant investment. Some, I think, have now got major concerns about staying in business. We've already heard of some significant providers that have left the market. Again, I think that's going to have an impact on the 3 million starts. So in terms of the concerns that some of us had and the arrangements for the procurement of non-levy paying employers that applies from May till December, are there any last questions on that? And again, make sure your MI team have sat down and done some of those calculations so as to see whether in fact your allocation was much less than you should have got based on historical data. Remember, it wasn't based on your plan or your bid, it was based on what you'd been doing before. So basically it was looking at the income you were getting from May 16 to December 16. So that would be the key thing. And you just use your PFRS to do this, your funding report to do this. But in fact, I think one of the big issues there is to just check what the baseline data is that was being used by by the ESFA, if you can get that. If there's not the clarification, then I think there's going to be, as we said, more misunderstanding. So what does this mean? If we're all now focusing increasingly on levy-paying employers, how are they responding? And I've really put them into 4 categories. We've been very lucky. We've worked with some levy-paying employers that have been actively engaged for months now with us. They see the possibilities. They're determined to use it strategically. They've actually exceeded the money in their digital accounts and are going for co-investment. It's a major push for changing that organization. Eyes wide open, managing the change. There's a second group that what we call watching the change. They're a bit confused. They're concerned. They're unable to see the possibilities. They might write off some or all of the levy initially. They're basically waiting to see what others do. I think there's a fair number in that category. I'm sure you've met these two. There's a third group which still concern me that we're not sure if we're paying the levy or not. If we are a levy payer, we'll get our heads around it eventually. And this often happens when they're part of a group or in interlocking directorships or whatever. And then there is a fourth category, and I'm sure you've met this lot. They still don't know when this is going to happen. We've had to tell them it happened in May, and what's it all about? So they didn't even know what the levy was about. And I've been talking to some training managers with levy-paying employers, quite substantial, who did not know what the levy was about and whether how it's going to be introduced. So any of you see any resonance there? I think one or two of you have already said working a lot with the third and fourth one. Thank you very much. That's a good point there. I think then what we've had to do, and this is us talking here as a main contractor, but also working with our subcontracting partners, is basically, and we've done this in terms of a previous set of webinars on preparing for the levy, is basically focus on a clear marketing, okay, just go back, just ignore that. We've had to focus on a clear marketing and branding strategy, clearing employer engagement strategy. We've been doing this for the last year and a bit. Selling the benefits of apprenticeships, including the off-the-job training. We've spent a lot of time looking at pricing strategies, but most important is to get the active involvement of the employer. So in terms of our marketing strategies, we've basically had to rebuild. In our case, we've had to rebuild the brand. I know in some cases, those of you who are going into this for the first time, it's building a brand. So we've had to have a clear statement of brand values. That's the fundamental principles, standards that drive the way we behave. So how are we behaving with levy-paying employers and with their staff? A unique position in their mind, in the market. How do they see us? Do they default to us as a college or a training provider? Do they have a view of us as being a big building with windows? Or do they see us as key players in improving business performance? So I think we've got to have a clear view how the training manager or employer sees us. And then last but not least, as part of our brand, the personality that we portray, the way in which the brand interacts, the tone of voice. Do we talk about in the business language? Do our sales staff talk business? Do they understand the nature of the business they're talking to? Do we come over as friendly, responsive, flexible, etc.? And then I think we've got to make sure that whatever the experience of the apprenticeship is, our brand comes to life. Our sales, our assessors, our tutors, all of the staff. We were talking, for example, about how our client services staff in college would relate to an employer that was a levy payer and to their staff who are apprentices. So it's creating that customer experience that brings everything to life. It brings our values to life, and it's all about people. It's, you know, do all the people in our organization understand how important apprenticeships are, and how important, in this case, a levy-paying employer is to our future business, and how we are important to their future business. And then last but not least, it's how we effectively communicate our brand and our offer to the levy paying market. Remember, whether it be someone like Sainsbury's, Balfour Beatty, you know, Mercedes-Benz, whoever it is who you're working with, is do we communicate it effectively? Do we understand the target audience? Do we understand who it is and how they buy? For example, when you're looking at buying systems, can we raise the importance of the need in our target audience? Do you do organizational needs analysis, for example, for nothing, to say, here are the benefits that are very specific to you that our analysis has shown. Now let's work on some kind of plan to do that. How visible are you in the market? Do levy-paying employers understand that you are an apprenticeship provider? Do they have you on their radar? So have you had the employer events, the mail shots, the site visits, the guest presenting, you know, your sales pitches? Have you been invited? Do you do business-to-business communications? Do you work with partners like the chamber? And what I think is critical there is, do we sell those benefits? Not just features. What's the unique point of difference between you and another apprenticeship provider? So if you're going to make the most of the levy, you're going to make the most of your brand. And how do we make it easy for the levy-paying employers to decide to purchase from us? And then what do they get afterwards? And one bit of advice is, with some of these large employers, we've actually found a particular niche for us is to help write their training provider engagement strategy. How do they engage with the world of education and training? And what's come out of that is not only how they engage with us on apprenticeships, but also on traineeships, and providing, for example, work placements for our students on study programs, which I think, again, is really helpful. So I think it's having that clear strategy, translate that into a very active engagement strategy. Put yourself in the shoes of an employer that's got to choose between you and another set of providers. You know, even if they go to the apprenticeship service and then look at who's available in our local area, who's available nationally, then I think we've got to make sure that we show that we've got proven track record, we can add value to the employer, we will help to embed a culture change with work-based learning. If they need not just apprentices in business, but maybe in IT or in service or in warehousing, we can scale up. We've got the capacity to do it either by ourselves or through our partners. Get them involved in design and delivery so that they have it the way that they want. These are big. Remember, levy-paying employers will often have HR departments and training departments who are your key partners. And we found increasingly what they really want is us to help source the talent through things like job search, through employability skills, through things like traineeships. So if you're talking to an audience that's an apprenticeship employer and they're evaluating and assessing the value of your offer, then they'll ask you for a fully costed proposal, which has got to be part of your price. And we've then got to make sure we can deliver apprentices within that funding band that perform better. So there's a real value here, and that's why the off-the-job training can help to have significant benefits to the employer in terms of what the apprentice brings back to the job, in terms of work-based projects, in changes in the apprentice's behavior that then lead to improvements in performance and culture change, and also that we're taking away some of the hassle for the employer. So we're offering a full service in that sense. So one of the things that we found quite useful was to sit down with employers and simply brainstorm all of the benefits that they could see from apprenticeships. And this is interesting. These are, you know, real things that employers, great. We can do apprenticeships at all levels. We can not only do apprenticeships for new staff, but for existing staff. We didn't know you could do this. And we get an element of contribution from the state. We love it. It gives us opportunities for personal growth. It's making our management more effective. The way you're delivering it is fit for purpose. We love it. There's qualifications to credit. That's one of the big disadvantages, by the way, of standards. But many employers are looking for this, particularly for the staff, and so are their staff. And also they said, well, wait a minute, the big difference with what you're doing through apprenticeships is we're not just getting competent staff, they're capable of performing consistently well and taking on new challenges. So it's all that added value. What we also found them saying is we now we know we can attract great staff because this is a great place to work. Why? Because we invest in our staff. And that's a significant benefit to the apprentices, particularly if they offer the job training, because you get new knowledge and skills, but also it creates a very different sort of, if you want, image for that employer. Apprenticeships provide structure. Look at the way that particularly some of the standards start to secure for people clear pathways, succession planning, etc. We can sell the benefits of apprenticeships. It builds on the reputation and legacy of the employer, which of course is critical when they're attracting talent. What about using, for example, the management standards to help the employer manage change or change their culture? The new standards at level 3 and 5, for example, in management, we found very good at starting that big business change that's needed. Then, of course, the employer can turn around and say, we're not only an employer of choice for new starts, for existing staff, therefore we've got less turnover, etc., and a greater return on investment. You know, don't forget, a level 3 apprenticeship compared to any other level 3 program delivers a greater return. £1 invested, £28 return. Sell those benefits. So you can make the most of the levy by not featuring. Don't spend a lot of time. I've just been looking at some of the information that some of the providers have put out. It's great to know it's a 2-year apprenticeship. It's great to know that the endpoint assessment is X. It's great to know that this is how the off-the-job training will work. But for me, the big thing is that it helps me as an employer to make the decision to use my levy and spend it with you is those benefits that we've actually got. And again, that comes into the pricing and payment strategy. So, you know, making sure that when you negotiate the price, emphasize the quality, emphasize the added value, make sure the contract's in place, make the payment easy, and then what a lot of employers have asked, particularly levy-paying employers that are not big, remember £3 million is the pay bill, is do you look after us as a full support service in terms of the admin, the paperwork, etc. They know that the money comes out of their levy account. They're the only people that can access that levy account in terms of the payments, but obviously, clearly, they're looking to you to help support them. And I think one of you has already said that you've found that the best way to make the best of the levy is to take so much hassle off the levy payer, and I think that's a good point. But last but not least, I think we still got to emphasize that the employer, right, you're a levy-paying employer, this is money that you're paying in through taxation, it's coming back through your account, it's investing in your staff, is that we still expect something from you. And this is just a very simple device. It's to get the employers to come up with, well, what do you think your part of the contract is? What's your contribution to this partnership? Personal commitment from the very top, making sure that they find the right provider. That's up to them through all of the processes we've described, making sure they agree a price that's fair, that reflects all the cost of assessment and training. Then obviously sitting down with you and delivering and agreeing the best way to deliver and administer it. And if you take a lot of that pressure off them, then it's part of the added value. Agreeing to the on-the-job and day release options or other off the job, such as through blended learning, through visits, through projects, whatever system you've got in place, make sure it's thoroughly resourced, and to sell the benefits of that. And then obviously to make sure that all of that happens and the learning is practical, the on the job and the off the job come together to provide those benefits. The employer to make sure they're there to coach and mentor through the workplace supervisor. Remember, these will often have training departments, and that relationship then with your assessor, workplace tutor, is then cemented. And they've then got to make sure they actively and openly support the apprenticeship right to assessment. So there's that continuity rather than obviously being the first to go. And last but not least, using some of your help, particularly if you've got specialist advice on processes, on training, it's using you, the provider, as a key partner in their training and development plans. And at the very end, both of you cheering on and celebrating the success of those apprentices. So I think I can see all of these as key aspects of making the best of the levy. So it's not understanding just the funding side of it, taking account of obviously the changes that were introduced after the 1st of May, but starting to have a very proactive, not reactive approach to engaging levy-paying employers who, after all, you know, are the big spenders in this. They might be small in number, but they are the big spenders. Think about local authorities, think about the National Health Service, think about the national large private employers that you could be working with. One little message was working with Premier League teams, football teams, is don't forget that Wayne Rooney's salary alone generates over £60,000 worth of levy. So that can be, you know, 20 admin apprentices. So it's just a sort of thing to don't engage directly with Wayne Rooney, but obviously you can see why it is important to work with these big employers and make the best of the levy. Are there any more questions then, Marek, at this stage? Some good questions coming there.
Yeah, any further questions? I've seen if there's anything else, and I think we've covered most. I think we've covered everything actually. Yeah, really good opportunity. Any other questions? Please feel free to use the question chat facility right now.
And can I just say also that if any of you are still going through modelling your allocation for non-levy paying employers up until the end of December this year, and you're still confused or concerned, just get back to us. Because we're quite happy to put one of our MI team to look at it to either confirm that you've been penalised or you've lost out, or maybe to confirm that the calculation is correct, particularly if you haven't had any responses from your ESFA contract manager or not the responses you expected. But certainly we've done that, and by then looking at what we trying to get as best as an understanding of what we're actually comparing like with like, it wasn't quite as bad as we first thought. So I think there's some good points there. Thanks for the questions and thanks for the comments. I hope you found that useful. As I said, in July we'll have a further set of webinars that are looking much more at the employer perceptions, because obviously employers are now giving us back the first few months' perceptions, and hopefully a lot of their confusions and concerns are being raised. Have been dealt with, and they're getting a greater handle. But certainly, we see this as a golden opportunity to expand the business, and certainly if we can get our branding, our engagement strategies right, we're very positive about the future. The big issue for us is going to be any downturn in economic activity, which obviously is not within our control. Great questions there, thanks very much. Clarification, yes. One of you has asked about the addendum. I'll find a particular addendum. It was an addendum to, it came from the the ESFA, and it was at the end of April. It's the addendum to the apprenticeship funding and performance management rules, May 2017 to March 2018, and it relates specifically to the separate rules for subcontracting delivery of apprenticeships for non-levy paying employers. So it's an addendum, and you'll see it has codes SC1. That's the nature of the report, subcontracting 1 to subcontracting 20. So there's 20 points there. And as I said, the 3 main changes I've actually told you about, but I think it's worth having a read, because some of the rules that were in the original apprenticeship funding and performance management rules don't apply. So you've got to be able to read that to fully understand it if you're a main working with a subcontractor, or if a subcontractor on the ROATP. Thanks very much for that. Thanks, Marek.
Brilliant. If there are any further questions, you've obviously got the contact details there, and that goes for anyone who's watching this recording now as well. You've got our contact details, so feel free to get in touch with us with any thoughts, and certainly anything that might come up on reflection and sharing with your colleagues. And Rebecca will make sure we get that text across to you as well as the point in the video to find the answers there. Excellent stuff. I'm going to stop the recording.